Okay, welcome to part 2. Now, we're going to take it away again. Nathan, AMM, market making. The remainder of the paper focuses on November 2007 to August 2011. During this period, we can identify high-frequency trading activity using the Financial Services Authority Saber-2 dataset. The dataset includes all transactions by observable high-frequency trading in the top 250 UK list stocks. To be the dataset of high-frequency trading firms must either be directly regulated in the European economical area, or must trade through a broker. We do not observe the trades of unregulated high-frequency trading firms that are placed directly on trading venues. Not crypto, just for that matter. Wasn't even really about then, was it? Let's face it. The Saber-2 dataset covers all transactions of the European economical area regulated firms in all debt, equity and equity derivatives instruments listed in the UK. Saber-2 and its successor Zen constitute a rich record of trading in one of the world's major financial centres, though they have only been used in 2 previous research studies. This FCA dataset captures most high-frequency trading activities in the UK until 2010. For 2010, we have an external dataset to corroborate our high-frequency trading activity measures, and the FSA dataset covers between 70% and 80% of total trading volume of the high-frequency trading until July. However, from August 2010, coverage falls to 40%. The decline is attributed to some high-frequency trading because direct members of the trading venues and no longer being obliged to report. Consequently, we focus on our analysis on the period prior to 2010, August. To study the role of high-frequency trading in institutional execution costs, first, we regard the level of high-frequency trading activities at the stock day level on the speed of the London Stock Exchange system. The regression includes a set of relevant control variables to control the long-term trends in high-frequency trading activities measures and isolate the short-term run impact of infrastructure change on high-frequency activities. We find that for 2 of the 4 London Stock Exchange systems changed before August 2010, high-frequency trading increases. We also examine execution costs around these technology changes, however, and find no measurable changes. These results together show little measurable effect on high-frequency trading on institutional execution costs. However, intraday prices are volatile, which causes execution cost measures to be highly variable and makes it difficult to identify small changes in costs. Second, under the maintained assumption of no effect on institutional execution costs through other channels, we can use an empirical method called 2-stage least squares to examine the impact of high-frequency trading on institutional investors' execution costs. This method estimates the influence of one variable on another. We believe that a negligible effect through other channels is plausible, as high-frequency trading are the most capable to quickly utilize low latency. We regard our execution cost measures on our estimated proxy for high-frequency trading from the first stage regression, continuing to find, however, no evidence that high-frequency trading has an effect on institutional execution costs. There you go. No real effect on institutional costs. Future work will attempt to extend our analysis to additional events that cause a variation in high-frequency activity, to include further measures of execution costs and examine other outcomes, including other components or transaction costs. The rest of the paper is structured as follows. Section 2 covers relevant background information. Section 3 discusses, well, we know what that is. Let's go to the background information. A variety of the papers have been written about computerized trading. Many of them coming from the United Kingdom government's Foresight project, the future of computer trading in financial markets. This section covers the most relevant driver report for this article. Below, we summarize the key findings of the Foresight driven reports on high frequency trading so as to provide the reader an overview of the main issues and clarify where our paper fits in this project. So, Hendershot of 2011 argues that high frequency trading are similar to other speculators in the market high frequency traders, similar to speculators. While they often improve price efficiency, they could also decrease it, possibly having a negative effect on institutional investors. He defines 4 main high frequency trading strategy: passive market making, arbitrage, structural and directional, and how they can affect quality. While passive high frequency trading market making should generally reduce transitory pricing errors, a structural strategy that takes advantage of stale non-high frequency trading orders could cause high frequency liquidity providers to withdraw from the market, potentially increasing transitory price errors. Generally, however, such competition should lead to more efficient markets. Arbitrage strategies can be viewed as an efficient way to provide liquidity, but could also lead to non-high frequency trading withdrawals. And while directional high frequency trading strategies based on identifying and trading against transitory price errors lead to more efficient prices, momentum ignition would increase transitory volatility. Rather than focus on trading strategies, Borgard 2011 decomposes the activity of high frequency trading based on the type of information they observe, and however it relates to their profitability. The speed at which high frequency trading participate in financial markets implies their trading decision depends on information that changes rapidly. This information includes order book dynamics, trade dynamics, past stock returns, cross-stock correlation, cross-asset correlation, and cross. So yeah, arbitrage strategies can be, while passive, no, we've read that bit, haven't we? Yeah. However, where are we? Arbitrage strategies can be viewed as efficient ways to provide liquidity but could also lead to non-high frequency trading withdrawals. And while directional high frequency trading strategies based on identifying the trading against transitory price errors lead to more efficient pricing, momentum ignition would increase transitory volatility. Rather than focus on trading strategies, Borgard 2011 composes, we've read that bit as well, haven't we? But we'll go on, we'll read it again. 2011 decomposes activity high frequency traders based on type information they observe and how it relates to profitability. The speed at which high frequency trading participate in financial markets implies their trading decisions depend on information that changes rapidly. This information includes order book dynamics, trade dynamics, past stock returns, cross stock correlation, cross asset correlation, and cross-exchange information delays. It can also include information that may be illegitimately obtained or created from front-running, quote stuffing, or layering. Hendershot 2011 and Borgard suggest there is a limited amount of information that can drive the trading activity and market participation of high frequency traders. While the information is limited, the way in which it is interpreted can vary from firm to firm. For instance, each firm may have a different parameter in its trading algorithm on how to handle different variables of interest, such as the slope of the order book or the depth of the best bid and offer. While both papers provide a useful overview of how high frequency trading might interact with data, their conclusions on the impact of high frequency trading are ambiguous. They do not provide empirical evidence on how it can benefit or harm institutional traders' trading activity. And again, we'll stop that there. Part 3 is around the corner. Just want to give this to you in little bite-sized sections. Nathan, what should I say, guys? Next video, here, there, wherever. See you in the next one. Smash the Zion coin up there.